Welcome back. In this lecture, we will start with the third chapter of our syllabus, the qualitative characteristics of financial information. In the last class, we studied about accounting standards, which we call as the IFRS. What is the full form? International Financial Reporting Standards. This means that the IFRS are basically the rules and regulations about how to recognize, measure, and present all the information in the balance sheet and P&L. That is how to recognize, measure, disclose the balance sheet, the profit and loss, the revenue, expense, asset, and liability items. Perfect. Along with this, there are some quality elements that also need to be satisfied when you prepare the financial statements. What does this mean? That let's say when you describe a person, you can describe him as intelligent, as punctual. These things can be measured, right? But when you describe the person as generous, as kind, these are qualitative characteristics. So like this, financial statements, while IFRS give them a quantitative idea about what to recognize, how to measure, etc., like we studied in the last chapter. It is also important to understand what kind of quality checks do the financial statements need to satisfy, right? Accounting practice has developed gradually over time. Many of its procedures are adopted automatically by people who have never questioned whether alternative methods exist which are of equal validity. However, the procedures in common use imply the acceptance of certain concepts which are by no means self-evident, nor are they possible concepts which could be only used to build up the accounting framework, right? Our next step is to see the more important concepts, qualitative concepts, when we prepare the financial statements. Perfect. Let's start with the first concept or the first accounting assumption, which is going concern. Now in the last lecture, I had given you a short summary about what is going concern. What does going concern mean? Now, there are multiple investors who or shareholders who have invested their hard-earned money in a company. Let's say L&T, Infosys, Kingfisher, etc. Right? Now, if they have a right to know whether the business is going to continue in the next short term or not, in the next near future or not. Near future generally being that of 12 months. Why is it necessary for them to know this? Because if they realize that this business will not survive, will not be existing after 12 months, they may decide to pool out their resources, to sell their investment, and to move on to another company. They have a right to know. Now, the business may close down due to two reasons. First is the business can no longer continue. It has become bankrupt. It is unable to continue, like in the case of Kingfisher Airlines. Or another is that the business has decided to close down. It could be a partnership or a company. It has satisfied its goal and now it has decided to close down. Either of the reasons, it is necessary to inform the investors whether the business is going to continue in the next near future, that is 12 months or not. Because if it is not going to continue, then the investors may sell off their investment and move on to other companies. Thus, if the business is going to continue in the next 12 months or so, it's called as the business being a going concern, ongoing concern. But if the business intends to close down in the next 12 months, they cannot prepare their balance sheet and P&L as per IFRS. First, they have to inform the all the company stakeholders, including the shareholders, and second, in the next year and in the current year, they have to prepare their balance sheet and P&L as per the breakup basis or the breakup system. What do I mean by this? Let's take a company. A company is preparing its balance sheet and P&L for the year 21-22, correct? Balance sheet and P&L for the year 21-22. correct? Now, a company does not have the need or the intention to close down, correct? So, a company is going to prepare its balance sheet as per the normal IFRS as it is a going concern or an long-term business. B company is preparing its balance sheet and P&L for the year 21-22. But B company is facing significant losses, having financial troubles. So it does seem so that B company has a need to close down probably in the next 8 months. Now, this year they are not going to prepare their balance sheet and P&L as per IFRS. They are going to prepare it as per a system we can call as breakup basis. And they are going to inform in the notes to accounts to their shareholders and all their stakeholders that they are no longer a going concern, right? I hope this is clear, okay? I'm just going to expand, just have a look at both the cases and then we'll continue. Perfect. Okay. So, the financial statements are normally prepared on the assumption that the entity is going a normal concern. Unless specified, we assume that all companies are going concerns and will continue for the foreseeable future. The foreseeable future being of 12 months. Hence, it's assumed that the company neither has the intention nor the necessity because of losses, because of troubles, nor the necessity to enter into liquidation and to stop trading. If such an intention or a need exists, the company is no longer a going concern and they have to prepare their financial statements based on, as I told you, the breakup basis. The concept assumes that when preparing the normal set to accounts, a business will continue to operate in approximately the same number for the foreseeable future. At least give an idea, investors say for the next 12 months. In particular, the entity will not go into liquidation or scale down in a material way. The main significance is that assets should not be valued at their breakup value, the amount they would sell for if they were sold off piecemeal and the business were broken up. What does this mean? If it is no longer a going concern, as I said, that we have to prepare as per the breakup basis. What does this mean? This means that there are chances we are going to liquidate and close down in the next 12 months. So obviously we are going to sell off the assets. In the breakup basis, we are going to value the assets. Not as per IFRS, but as per their current market value. Why current market value? Because obviously in the next few months we are going to sell off these assets and close down the business. So not as per IFRS, but as per their current market value. Okay, I hope this is clear. Let's take up a question in the study text. A retailer commences business on 1st of January and buys inventory of 20 washing machines, each costing $100. During the year, they sell 17 machines at $150 each. How should the remaining machines be valued on 31st of December? First, if they are forced to close down the business at the end of the year and the remaining machines only had a value of $60 each. So if they are forced to close down by the end of the year, they are no longer a going concern. So you have to show the assets as per their current market value, which is $60 each. Perfect. So 3 machines into 60, that is 180. But if they intend to continue in the next year, then what is their cost value? They are made at $100 each. So therefore 3 into 100, which is 300, because it is a going concern. So there is a good chance that they would go in the next year, sell it at 150 and thus earn a profit like the other 17 machines. Okay, I hope we are clear with this. If a going concern assumption is not followed, then the fact must be disclosed. As I told you, the basis on which the financial statements are prepared, right? Now they will be no longer as per the IFRS, but they will be as per the breakup basis. And the reason why it is no longer a going concern, is there a deliberate action? Intentionally they had decided that for 3 years they'll continue and now they're closing down? Or is it because they are having financial troubles and can no longer continue? It could be either of these two. Perfect. Let's go down to the next accounting concept, which is accrual. Now, what do we mean by accrual? Accrual is basically income and expense should be recorded when they have been incurred or earned and not when they are received or paid. Okay, very simple. When they are earned and not when they are received or paid. What is the meaning of this exactly? See, let's first take an example. Yeah, Emma purchases 20 shirts in the first month of trading, May, at a cost of 5 each. She then sells all of them for 10 rupees each, purchased at 5, sold at 10. Emma has therefore made a profit of 100 by matching the revenue concept. Okay, all of Emma's shirt sales and purchases are on credit and no cash has been received or paid. Okay, now the question is, for example, in the first chapter I told you about debtors and creditors. What is the meaning of debtors and creditors? Let's revise one more time. If let's say Emma has sold a shirt to a person, Emma sold a shirt to a person who told her that I cannot give you money right away. I can pay you in 3 months. Then Emma says no problem. She sells the shirt on 1st of July. He has to pay her on 1st of August, September, 1st of November. Correct. Now, in the meanwhile, Emma shows this person as a debtor with the value of that shirt. Let's say 100 rupees. Now the question here is that would you recognize this sale on 1st of July or would you recognize it on 1st of November when you have actually received the money? Correct? Accrual concept says that you show this transaction when it is occurred and not when the money is received. Very important. When the transaction actually takes place and not when the money is actually received. So according to that logic, Emma should record this sale on 1st of July. And on this, she cannot record the sale, but she can only record the cash being received because the sale is already recorded here. Similarly, let's say for this sale, Emma buys the shirts from a supplier, right? Emma has bought the shirts on 1st of February and she tells her supplier that I don't have the money for it immediately. I will pay you in 3 months. So she also takes 3 months and she is going to pay on 1st of May. Now the question comes, do we recognize the purchase in our books? In Emma's books, it will be purchase. So Emma will show a liability of this creditor of whatever, let's say 70 rupees. So will the purchase be shown on 1st of February or 1st of May? Same logic applies. We have to show as per accrual when the transaction has occurred, not when the money has actually been paid. So we'll show the purchase on 1st of February itself. On 1st of May, we will simply show the cash being paid, but the purchase we'll show when it has actually been done, that is 1st of February. This is a very important concept of accounting. I repeat, transactions are recorded when they have actually happened, even if the cash has been paid at that point or not paid at that point. Same way, even if the cash has been received at that point or not received at the point. They are recorded when they actually occur, correct? So in this case, Emma 20 shirts in the first month of trading, correct? So Emma will record full revenue. If however, Emma had sold only 18 t-shirts, it is incorrect to charge her P&L with the cost of 20 shirts. Why so? How much has she sold? 18 shirts. Then cost kitne ka lege? Only 18 shirts. This is called as the matching concept. That is, the number of units the number of units in both purchase and sale column should be the same, correct? I'll give you another example. Let's say in the month of May you're selling mangoes, right? In this week you have sold 1000 mangoes, but you have purchased 1500 mangoes. When you make the profit and loss, would you say that 1500 purchased but 1000 sold? Would it be fair? That won't be fair. So you only show 1000 purchased and 1000 sold. What about the rest 500 that you have purchased? You show that as your stock, as your surplus items that you will sell in the next week. You got it? 1500 mangoes were purchased, only 1000 sold. You're wondering what about the next 500? That will be your surplus stock to be sold in the next week. But right now you're only going to compare the cost of 1000 mangoes with the revenue of 1000 mangoes to see if you have a profit or a loss. In the same way, if Emma had sold only 1800 shirts, she will take the cost of only 1800. So the cost will be, if she had only sold 18 shirts, cost will only be for 18 shirts. The 2 extra shirts, she will take it as stock or surplus to be sold in the next month. So cost will be 18 into 590. Selling price will be 18 into 10, which is 180. So 180 minus 90, she has a profit of 90. I hope we are clear with accrual and the matching concept. Okay. Just look at the Excel once. See if you have understood everything. Okay. Okay. The effects of transactions and other events are recognized when they occur and not when the cash is actually paid or received. Now, it could so happen that in this case the cash is also received on 1st of July. Great. Then the transaction will be recorded on 1st of July. But even if it is received before or after, it will be recorded when the sale actually happens. That is 1st of July. Clear? That is the right date. So cash may or may not be received. Cash may or may not be paid. But transactions are recorded when they actually occur, correct? And are reported in the financial statements. The accrual basis is not an underlying assumption, but it makes it clear that financial statements should be prepared on an accrual basis. Entities should prepare their statements on the basis that transactions are recorded in them, irrespective of whether cash is paid or received, but when that revenue or expense has been incurred or earned. That means when the transaction of that revenue or expense has actually taken place. On that day, we are going to record that transaction. According to the accrual assumption, in computing, that is in calculating the profit, revenue earned must be matched against the expenditure earned. As I told you, when you have earned revenue for only 18 shirts, the cost should also be shown only for 18 shirts. That we call as the matching concept. Okay, so I hope we are clear with the matching concept and we are clear with the accrual concept. Let's go on. Now, we go on to the qualitative characteristics. So what do I mean by qualitative characteristics? Right, before we go on, let us just check Emma's example in detail ahead. So as I told you that she has just sold 18 shirts. Okay, so what all will we show in our balance sheet? First of all, the surplus. So as I said, there are 2 shirts which she is going to sell in the next month. Okay, now at what cost did we make these two shirts at 5 each. So we show inventory, that is the stock, under current assets at 5 into 2, which is 10. Perfect. Now Emma has sold these 18 shirts, but we have been told that she has not got the money on the spot. So all these people become her debtors. Emma has sold at what value? 10 rupees each. So 18 into 10, which is 180. Clear? This will be in the assets part. In the liabilities part, how much, as I told you, the profit will be added in the owner's capital. How much is the profit? 90 rupees. That will be shown in the capital addition. And for these 18 shirts that we have purchased at 5 rupees and we have still not paid the money. So this becomes our creditor, which we show in liabilities. How much? 20, 18 which are sold and 2 more which are purchased, that is 20 into 5, which is 100. Can we tell the supplier that no, right now I have sold only 18, I'll give you money for only 18. But he tells you no, but you purchased 20, you have to pay for 20. So 20 into 5, we'll show it as creditors, 100. Okay. However, if Emma has decided to give up selling t-shirts, then it is no longer a going concern and the shirts will be shown on breakup value. Clear? Similarly, if the 2 unsold shirts are likely to be sold at the cost of 5 at more than the cost, then they should be recognized at the net realizable value. So net realizable value is a concept which we'll do in some time in the next chapters. Right now you have to understand the matching concept. 18 shirts ka revenue, 18 shirts ka cost, and what do we do of the next 2 shirts, and how do we show the debtors and creditors. Debtors are accounts receivable, creditors are accounts payable. This much you need to understand. Okay, I hope everything is clear up till this point. Right? Okay. Now the qualitative characteristics. First, so what are qualitative characteristics? Those that make the information highly useful to the users, that will add value to the users. The first qualitative characteristic is relevance. What do we mean by relevance? Relevance of financial information is capable of making a difference in the decision made by users. Financial information is capable of making a difference if decisions have predictive value, confirmatory value, or both. What do we mean by this exactly? See, for example, you tell your parents that you want to go to a Goa trip, correct? And your parents are skeptical about it. But you tell them that one of your sincere friends is coming. So then the parents start considering that might be then you will be fine and you can go, right? That was a very relevant information because that affected the decision that you took your parents, that the decision the parents finally gave you in order for that trip. Similarly, whenever we are deciding what information to include, we must include that information that will impact the decision of the investors and the stakeholders, correct? We have to include information like salary cost, which are important to the employees, to the loan repayment, which are important to banks, to the revenue and profit, which are important to shareholders, so on and so forth, right? The predictive and confirmatory roles of information are interrelated. Information on the financial position and performance is often used to predict future position and performance and other things of interest to the user, like dividend, wages. The manner of showing information will enhance the ability to make predictions. Okay, highlighting unusual items. Relevance of information is affected by its nature and materiality. What do we mean by this? So, some information can be predictory and some information can be confirmatory. What are the kind of information that are confirmatory that I am talking about here? let's say your investors are interested in how much is your sales of this year, right? This is confirmatory information because you are going to reveal your sales in the profit and loss statement. So you're going to confirm to them how much is your sales. Another type of information is predictive information. The shareholders are very interested, they are predicting how much dividend they will get in this year. That will be also disclosed in the balance sheet and notes to accounts. So this is an example of predictive information. Right now what you need to understand is what makes relevant information. Relevant information is anything that will change or affect the decision of the stakeholders. Let's say you have expanded into a new region, relevant information. You have sold off a branch, relevant information. You have taken up a new merger, Vodafone Idea, relevant information. You have laid off 10,000 employees, relevant information. Making sense? So all the information which is important to the users. Okay? Right. The next one is materiality. What do we mean by materiality? Materiality is very important. Okay. Now, if you want to give a presentation to your boss about the sales in this quarter, correct? About the sales in this month. Now, tell me, will you tell him about such sales of customers which are like 2%, 4%, 1%, or customers which are 20%, 40%, 30%? You would naturally answer 20%, 30%. Why so? Because these are important customers. You have to pay special attention to them. You have to focus on them. You have to make sure that the needs are met. Even if a customer of 1% leaves, the business will not be impacted that much. So these customers are material and your presentation should definitely focus on them. Similarly, when preparing the financial statements, information is material. If omitting, that is leaving it, or misstating it, that is giving it wrong, could influence the decisions of the users of financial statements. Let's say we had a revenue of 15 lakhs and 15 lakhs 20,000 and by mistake we wrote it as 20 lakh 15,000. Isn't that material? That is. Or let's say we have taken a big loan in this year and we omitted to give it in the balance sheet. Wouldn't that affect the users? Of course it would. So do not skip or omit or misstate. Misstate is state incorrectly. Do not misstate or do not omit any important information. What is important information? Information that the users find important. Okay, information that the stakeholders find important. Do not skip any of this information. Okay. An error. Last time we saw the difference between error and fraud. Error is what is made unintentionally. You're picking up your bag and by mistake you picked up that 500 rupee note. Error. You're picking up of your bag, saw that note, picked it up. That is a fraudulent activity. So an error which is too trivial to affect anyone's understanding of the account is immaterial. In preparing the accounts, it is important to assess what is material and what is not, so that time and money is not wasted in the pursuit of excessive detail. Correct? So for example, let's say that you are studying for an exam and there is a part of the syllabus which the teacher has told you is for option, and it is a very simple concept and yet you spent 3 hours on it. Was that the right decision? No, because it is a trivial, it is a not so important concept. So in business as well, errors which are very small, very negligible, very trivial may be left out. Important elements, important amounts should be disclosed, all of them, and without any error. That is what we call as materiality. Correct? Let's take up an exercise. If a statement of financial position shows non-current assets of 2 million, that is 20 lakhs, and inventories of 30,000, okay, an error in the depreciation calculations, an error of 20,000 in the depreciation calculation may not be regarded as material. But if there is an error in the inventory is total of 30,000, out of which you make an error of 20,000. 2 divided by 3, that is 66%. That is a significant error. So that in inventory is considered material. Making sense? For example, if a business has a bank loan of 50,000 and 55,000 balance on bank deposit account, it will be considered a material misstatement if these two amounts are netted off in the statement of financial position as a cash at bank of 5,000. In other words, incorrect presentation may also lead to material misstatement. What do we mean? We have money in SBI account 55,000. We have also taken a loan from HDFC of 50,000 or even from SBI of 50,000. Can they be cancelled off against each other? No, definitely not, because those are two different transactions. So if we net them off against each other and show a bank balance of 5,000, that is a misstatement, that is a wrong presentation, and that will also be a material error because it is an important amount, big amount. So misstatement as well as omission of important items, both should be avoided. That is a concept of materiality. Next concept is faithful representation. For the shareholders and stakeholders to trust you, it is important that all the amounts in the balance sheet and P&L are free from any error or fraud. Very important. Okay, so error means any unintentional mistake. Fraud is an intentional mistake. But to have a faithful representation, information should be complete, nothing should be omitted, neutral, no bias, not trying to show a positive picture or a negative picture, and free from any error and fraud. Correct? A complete depiction includes all the information necessary for the user to understand the phenomenon being depicted, including wherever necessary the description and explanation. So in faithful representation, basically the agenda is to be as honest as possible, okay, to give all the information, to give a bias free information and free from any error and fraud. A neutral depiction is without bias. A neutral depiction is not slanted, emphasized or manipulated. You are not trying to show your shareholders, look how lucrative our revenue is, but you may have taken a big loan that is risky and you try to hide it. No. Or you may show that how much we pay to our employees, but without showing them how much you exploit the environment, hiding that element. That is not okay. So neutrality, no kind of bias, favorable or unfavorable. Correct? Free from error means that there are no errors or omissions in the reported information. All the reported amounts and information should not have any error or fraud. In this context, free from error does not mean perfectly accurate in all aspects. This is very important. Now, as you proceed in F3, you will understand that some items in the balance sheet are a judgment call. What do we mean by this? Okay, now we have just seen that debtors, okay. So debtors in our example, let's say we had debtors of 100, correct? Now out of which, let's say there are 5 debtors. 5 debtors that a company has and their total is 100. Out of which we find that 4 debtors are fine. But 1 debtor, or let's say 3 debtors are fine, but 2 debtors out of which look doubtful and we don't think they'll be able to pay the money. So therefore, we show these 2 debtors as doubtful debts. Now this is a judgment call. We cannot get this accurately and their amount is 35. When the actual time came, let's say one of them paid and one of them only did not pay. So the actual loss only was of 1 debtor, let's say amounting to 50. Does this mean that previously when we said 35 there was some error or we were doing it intentionally? Not at all. It was just a judgment call that was not accurate. So just because judgments can go right or wrong does not mean that there was error. Okay, so judgments are free from error anyway. Judgments can go upar niche, can go right or wrong. That does not mean that, so that does not mean that there was some mistake in them. This is the meaning of faithful representation. Free from error, no bias, and complete information. Okay, we'll move on to the next concept, which is substance over form. Right. So substance over form means that commercial reality of a transaction should be reflected in the financial statements, and this takes priority over the legal form of an arrangement. I'll give you a simple example. So that this basically means that the reality should be seen over what appears on paper. So to give you a simple example, let's say there is a couple, husband and wife, married for over 12 years, correct? They have been separated for the last 5 to 6 years and not yet divorced. So on paper we can say that they are married, definitely, but in the reality, so the substance is, on paper it is that they are married, but in reality they are far from being married. They are separated for a while now. There are no chances that they might get back and reconcile. So the reality is that they are now living as individuals. So there is the reality which supersedes or which takes priority over the on paper thing. To give you an example in business, when an entity makes a sale to a customer, there is an expectation that the customer may return the items to the entity. Okay, so when should the entity recognize the sale? When it has actually done the sale, or when the time period to return has expired. Let me give you an example. Let's say you buy clothes from a shop on 1st of July and he says that 10 days you can return it, correct? So do you record on 1st of July when on paper the sale happened, or on 11th of July when the return period is expired? Okay, so substance over form says that the entity does not recognize the revenue unless it is completely certain that the customers will not return the clothes. So obviously it is completely certain by 11th of July that the customers will not return the clothes, and thus the sale will be recorded on this date and not on 1st of July. Okay, I hope this is clear. This is basically the example of substance over form. Now, after qualitative characteristics, we'll go on to some enhanced qualitative characteristics. We have completed a faithful representation, substance over form. Now we are going to go to enhancing quality characteristics, which improve the quality and value of the balance sheet and P&L. Okay. First one is comparability, very important. Yesterday also I specified on this a lot, that balance sheet and P&L are made as per IFRS in order to make them available for comparison. Okay, it is very useful if the balance sheet and P&L of one entity can be compared to. Now there are two types of comparison. First is inter-firm and second is intra-firm. Inter-firm is against its competitor. So as I said, let's say Vodafone Idea and Jio, that is inter-firm comparison. Intra-firm is Jio's own comparison with its last year comparison. That is called as intra-firm. So therefore, we should be able to compare inter-firm as well as intra-firm. Only then we'll be able to see if the business is doing well as compared to its own performance in the last year and as compared to its competitors. Verifiability helps assure users that the information is faithfully represented, that is complete and without error. It means that knowledgeable and independent observers could reach consensus, although not completely agreement that a particular depiction is a faithful representation. Verifiability is, for example, if you say that the assets are of 80,000, you should have the documents to prove it. Otherwise, you may not be saying honestly. So verifiable. Everything that you say should be verified with the help of evidence and documents. Can be verified. Correct? Timeliness, very important. Timeliness means having information available in a time to be able to take decisions. Generally, the older the information, the less useful. Let's say you're giving the balance sheet for year 20 to 23. That is, the year finishes by 31st of March 2023. And if you give the balance sheet in 2028, will it be of any use? No. So give it in a reasonable time that will help the users. Information may become less useful if there is a delay in reporting it. If there is a balance, also by giving it in time, do not rush it. You should faithfully represent it, but give it within time. So there is a balance that you need to seek within these two things. Conversely, if every detail of a transaction is known, basically that means you are not following materiality, correct? If every detail is shown, then it will be too late to publish the financial statements and they will become irrelevant by that time, correct? Next one, understandability, very important. Classifying, characterizing and presenting information clearly and concisely makes it understandable for everybody. You are not giving financial statements for analysts and CFAs only and CAs and ACCAs only. You are giving it for everybody. So try to keep it as simple and concise as possible. Financial reports are prepared for users who have a reasonable knowledge of business and economic activities and who review and analyze the information diligently. Some phenomena are inherently complex and cannot be made easy to understand. Excluding information may make it easier to understand, but the reports would be incomplete. Don't exclude any information just because it is very complex, like let's say how AI works or how some chemical plants are working. They may be very complex. So you're saying that no, it should be understandable, let's omit it. No, that is not correct, because the balance sheet and P&L should be complete, should be faithfully represented. So don't omit anything just because it is complex as well, correct? Therefore, matters should not be left out for financial statements only because they are difficult, as even well-informed users may sometimes need the aid of an advisor to understand information. So try to keep it as simple as possible, but if there is complex information, don't exclude it. Put it in the balance sheet and P&L. The users who can't understand it will then take the help of CAs and CFAs and financial advisors. Okay, so that is the concept of understandability. Now consistency, very important. To maintain consistency, the presentation should be same every year. If you change your policies every year, then how do you compare your performance against your performance with the last year, correct? So therefore, you should keep your policies consistent over a period of time. There are two exceptions to this, unless there is a significant change in the nature of operations. Earlier you were in the business of making softwares, now you are in the business of making cars. Obviously you can't continue the same policies, and if the change is required by IFRS, if the accounting standard itself changes, obviously you have to adapt to the new change. But you will adapt prospectively, iske aage, not retrospectively, not going back, you will change prospectively. Okay. The last concept is the business entity concept. Now the business entity concept says that the business is always separate from its owner. That means that our transactions of a company cannot be intermingled with that of an owner. As I told you yesterday that if there is a transaction being entered into by Reliance, it will be in the name of Reliance Corporation and not in the name of Ambani's, the individuals, correct? So therefore, the business transactions should be kept separate from that of the owners of the business. The business enters into its own transactions, takes up its own liabilities. Thus in a company, even if the business goes into a loss, as I told you yesterday, the shareholders' property will not be attached. The business own property will be attached. Business entity concept. The company is separate from its owners. Where is the business entity concept not applicable? Sole traders and partnerships. Okay. Let's get into questions. The conceptual framework identifies characteristics which make financial information faithfully represent. What do we mean by faithfully represented? Neutrality and accrual, neutrality from error, accruals and free from error, accruals and going concern. So faithfully represent matlab basically free from error. So free from error, complete, and make sure that it is complete, it is free from error, and it is not misstating, correct? Which of the following describes the consistency concept? Only material items are disclosed? No. The way an item is presented always remains the same? No. Presentation and classification should remain the same unless there is a change in the business or unless the IFRS tells you to do so. So that is option number 3. Okay. So with this we come to an end of chapter 3. In chapter 3 you have studied important concepts. First is going concern, accrual and matching, relevance, materiality, faithful representation, substance over form, comparability, verifiability, timeliness, understandability, and consistency, and also the business entity concept. I hope everything is clear, and with this we conclude to the third chapter. Thank you.